So, Contango Silver and Gold posted a mixed Q2 2026 today. They missed adjusted EPS estimates, but actually delivered a GAAP beat.
Yeah, a really interesting print to dig into.
Right. The company reported GAAP EPS of 14 cents per share, peak gold joint venture revenue of 125 million, and, they reaffirmed full year 2026 gold production guidance of 40,000 to 45,000 ounces.
Which is pretty bold given the current metrics.
Exactly. Because despite that adjusted earnings miss and the fact that they are currently bleeding almost $2,900 to pull a single ounce of gold out of the ground, the stock reacted positively.
Right, it was up, what, like 3.5%?
Yeah, rising 3.54% to close at $20.20 in regular trading.
So looking past that top-line summary is completely mandatory for a print like this. Institutional investors are clearly tracking a totally different set of metrics than the headline EPS.
Yeah, because we need to bridge the gap between those GAAP and adjusted numbers. Plus, evaluate that severe margin squeeze at their Manh Choh mine and, analyze the massive financial rewiring management just pulled off to give shareholders 100% exposure to spot gold prices.
Right, to decipher that 14-cent EPS and why the market cheered for it, you really have to look at the joint venture accounting mechanics first.
Well, let's start right there on the income statement, because there is this glaring quirk that trips up a lot of automated screeners.
Oh, the $0 revenue line.
Exactly. Direct GAAP revenue for Contango is listed as $0. But the Peak Gold joint venture, which Kinross operates and Contango holds a 30% interest in, generated $125 million in gross revenue.
Which was actually down about 36% year over year.
Right.
It's a classic case of equity accounting in the mining sector.
Yeah.
Because Contango owns a minority 30% stake, they don't consolidate the joint venture's gross revenue onto their own top line.
They just recognize their share of the net income further down.
Exactly, as a single line item. The heavy lifting happens at the project level with Kinross. So at the corporate level, their 30% share of Q2 production was 8,885 ounces of gold, and they sold 8,627 of those.
Okay, but I have to push back on the cost of producing those specific ounces because, the Q2 operating margins look like a disaster on paper.
Yeah, they do.
Cash costs came in at a staggering $2,641 per ounce, and the all-in sustaining costs, the AISC, hit $2,877 per ounce.
It's a massive number.
Right. Yet management just reaffirmed their 2026 guidance, telling the market to expect $1,900 to $2,000 for cash costs by the end of the year. How on earth did they justify a $1,900 target when they're spending almost $2,900 to get an ounce out right now?
Well, it looks completely contradictory until you map it to the actual mine sequencing at Manh Choh.
Okay, walk me through that.
So what you're seeing in those inflated Q2 costs is just a temporary operational bottleneck. During the second quarter, Kinross was mining the very last remnants of the North Pit.
Ah, so they're shitting the end of that zone.
Right. When you deplete a pit, you are essentially scraping the bottom of the bowl. The grades drop significantly. But simultaneously, you have to mobilize your heavy equipment fleet to start pre-stripping the waste rock away from your next target.
Which is the South Pit.
Exactly.
So they're absorbing the upfront capital costs of moving massive amounts of sterile dirt in the South Pit while only processing the lower-grade dregs of the North Pit through the mill.
Yeah, and that mathematically crushes the margin for a quarter or two. It creates this severe unit cost distortion. You're incurring dual operating costs, but, recovering way less gold.
Okay, so the entire basis for reaffirming that lower guided cost relies completely on crossing the threshold into the South Pit's main ore body.
That's the entire thesis. The geological models show that both the tonnage and the grades increase materially in the South Pit. Management is really banking on this shift to drive second-half production to over 41,000 ounces.
Right, because by increasing the denominator, the total ounces produced, those fixed mining costs get spread over a much larger base.
Exactly, pulling the cost per ounce back down to that $1,900 range.
Okay, that operational pivot makes sense, and it explains why the market is looking past the Q2 margin squeeze.
Well, that, and you have to contextualize this single quarter against the macro project economics. Contango's initial capital investment to build out their 30% share of Manh Choh was $105 million.
And the project has already returned $160 million in cash distributions back to them.
Exactly, meaning they are fully paid back on their initial construction capital, with $55 million in pure profit already on the books.
Yeah, they even got a $9 million cash distribution in Q2 alone, despite those high costs we just talked about.
Right, so everything pulled from that South Pit moving forward is pure upside.
But, the operational margin squeeze is really just one side of the coin here. The more pressing issue this quarter was the financial margin squeeze.
Oh, absolutely. The hedge book.
Yeah. The mine sequencing inflated their operating costs, but the true anchor dragging down their cash flow was that legacy gold hedge book. Looking at the cash flow statement, year-to-date operating cash flow was deeply negative.
Yeah, they burned $50.3 million in operations.
Right. And the primary culprit is that they paid out $50.9 million in cash just to settle underwater gold derivative contracts.
It's painful to look at. And this ties directly back to that 14-cent gap EPS beat we mentioned at the top.
Oh, right, because of the paper gains.
Exactly. That headline beat was heavily inflated by a $10.3 million non-cash gain on these exact derivative contracts. You strip out that accounting gain, and the company actually posted an adjusted net loss of $5.5 million.
Wow. And that adjusted net loss is obviously a far more accurate reflection of the cash hemorrhage those hedges were causing.
Yeah, to understand why a junior miner gets trapped like this, you have to look at how mining debt is actually structured. When Contango needed that initial $105 million to build Manh Choh, the project finance lenders required them to lock in a floor price for a percentage of their future gold.
Right. It guarantees the banks get repaid even if commodities completely crash.
Exactly.
But the problem is they locked in those 2027 hedges at $1,935 an ounce.
Which turns into a financial nightmare in a commodity bull market. It's basically like being forced to sell your house at 2015 prices during a 2026 real estate boom.
Yeah, with spot gold surging well past $4,000 and Contango hitting an average realized price of $4,328 in Q2, delivering gold into a $1,935 contract is just a massive opportunity cost.
It's brutal. Every single ounce delivered against that hedge represented thousands of dollars in lost revenue that belonged to the shareholders.
So management realized the bleeding is unsustainable and they ripped the Band-Aid off on July 1st.
They had to.
When you look at the mechanics of this credit facility amendment, it's essentially like refinancing a high-interest credit card while simultaneously buying a catastrophic insurance policy.
Yeah, that's a great way to frame it. The engineering behind that July 1st amendment is arguably the most consequential move the company has made this year. They completely eliminated the remaining 15,000 ounces of 2027 gold hedges.
But obviously, you don't just walk away from a bank contract.
No, you have to monetize that liability. So they converted the negative value of those toxic hedges into $33.7 million of additional secured debt.
Right. So the total drawn on their amended credit facility jumped from roughly $12.6 million to $46.3 million. And normally, adding over $30 million in debt to a junior mining balance sheet usually terrifies the market.
It does, yeah, until you evaluate the cost of capital and the actual terms. By shifting this from a derivative liability tied to spot prices into traditional corporate debt, the interest rate actually dropped from 8.9% to 7.4%.
Oh, wow.
Yeah, but the real victory is that it untethered their gold production. They are no longer structurally forced to sell at $1,935.
Okay, but to satisfy the lenders who still needed downside protection on that new $46.3 million facility, Contango purchased 15,000 put options at a $3,100 strike price.
Right. A put option establishes a hard floor. It gives Contango the right, but, not the obligation, to sell 15,000 ounces of gold at $3,100.
Right.
So if the global economy shifts and gold crashes back down to $2,500, Contango is guaranteed that $300 to $100 price, which ensures they can service the new debt.
But if gold stays in this 4,000 plus megatrend we're in, they just let those put options expire worthless and sell every ounce at the spot price, capturing 100% of the upside.
Exactly. And that perfectly explains the stock price bump. The market absolutely despises capped upside during a commodity run.
Right.
By absorbing the debt to kill the hedges, Contango is now a fully unhedged producer, just as Manh Choh is about to hit that higher-grade south bit we talked about.
The timing on that is highly strategic.
Very.
Because with the balance sheet unhedged, Manh Choh is projected to distribute between $36 million and $60 million in cash during the second half of 2026, assuming these elevated gold prices hold up.
Right.
And combined with their existing balance sheet, Contango ended Q2 sitting on an $89 million cash position.
Which is huge. For a company of this market capitalization, $89 million is a formidable tool for aggressive growth.
So let's look at how they're deploying that war chest to actually build out a mid-tier producer, because their development pipeline is moving really aggressively right now.
Yeah, they aren't sitting still.
If we frame this in terms of risk and reward, The Lucky Shot project looks like their near-term, low-capital, quick win.
Definitely.
They bought out the underlying lease and a 2% net smelter return royalty for $16.07 million, and they settled $18.75 million in legacy milestone payments for just $6.6 million in a mix of cash and stock.
Buying out a net smelter return, or an NSR, is a crucial de-risking step. An NSR is basically a royalty where a third party takes a percentage of the gross revenues from the mine, regardless of the operating costs.
It skims right off the top.
Exactly. It severely punishes operating margins. By paying $16 million to consolidate 100% ownership and eliminate that 2% royalty, Contango gets to keep every dollar of margin generated.
And that margin potential is pretty staggering when you review the recent drill results from Lucky Shot. They reported a high-grade underground drill intercept of 972.10 grams per ton gold.
Yeah, nearly a full kilogram of gold in a single ton of rock.
It's wild,
Yeah.
which leads directly into their strategy of targeting a direct shipping ore, or DSO, feasibility study for 2027. Wait, so direct shipping ore, does that literally mean the rock is so rich they don't even need to build a processing mill? They just blast it and put it on a highway to a third-party smelter?
That is the exact mechanism, yeah. Typically, mining requires hundreds of millions of dollars in upfront capital expenditure just to build a milling facility on site. You have to crush the rock, apply chemical leaching, and, pour a doré bar yourself.
Right, the traditional route.
But with direct shipping ore, the geology is so exceptionally concentrated that you can bypass the mill construction entirely. You just extract the raw ore, load it onto trucks, and pay a toll fee to an existing regional mill or smelter to process it for you.
Wow. So Lucky Shot provides a pathway to 40,000 to 50,000 ounces of annual production with drastically lower upfront capital requirements.
Exactly. It's highly capital efficient.
But, if Lucky Shot is the quick, high-grade win, the Kitsault Valley project they acquired through the Dolly-Varden merger earlier this year is the massive long-term swing.
Oh, absolutely. Kitsault Valley represents a district-scale silver play in British Columbia's Golden Triangle. They initiated a 40,000-meter drill program there, and they've actually already completed 35,000 meters.
Why does completing that drilling early matter so much to the bottom line?
Well, drilling in the Golden Triangle is a massive logistical challenge. It often requires helicopter support, and you are constantly racing against the winter freeze.
Right, weather is a huge factor.
Yeah, so finishing under budget and ahead of schedule saves millions in rig rental and camp support fees.
Yeah.
But more strategically, accelerating the data collection allows them to feed those drill core assays into an updated mineral resource estimate scheduled for Q3.
And that resource estimate forms the mathematical foundation for their initial assessment and preliminary development plan targeted for 2027.
You got it.
Okay. Then there is the third pillar of this growth strategy, the Johnson Tract project in Alaska. It's a polymetallic deposit, and they are already conducting earthworks for the access road.
Yeah, moving dirt.
But the key detail here seems to be the permitting process moving forward under the federal FAST-Hay 41 program.
Gaining FAST 41 status is a major catalyst for any mining project. Historically, mine permitting in the U.S. can just suffer from years of bureaucratic purgatory as different federal and state agencies conduct isolated environmental reviews.
It takes forever.
Right. FAST 41 is a federal framework designed to force all those agencies to coordinate on a public, transparent dashboard with strict, predictable timelines. It doesn't guarantee the permit will actually be approved, but it guarantees a timeline. And that provides the regulatory certainty institutional investors demand before funding underground exploration.
Okay, so we have Lucky Shot targeting near-term DSO, Kitsault Valley expanding a massive silver resource, and Johnson Tract advancing infrastructure under federal oversight.
It's a full plate.
It really is. And this raises a major structural question about their balance sheet. They are advancing 3 highly capital-intensive development projects simultaneously. At the same time, they just added $33.7 million in new secured debt to kill those hedges, bringing the facility to $46.3 million.
Right.
Plus, they still have $20 million in convertible debentures, meaning debt that could eventually convert into equity and dilute current shareholders.
Yeah.
So when you run the liquidity metrics, their current ratio is 1.27. So they have $1.27 in liquid assets for every $1 of short-term liabilities. For a junior mining company that doesn't have a broad portfolio of producing mines yet, is 1.27 too tight? Is management stretching this company too thin in pursuit of this 200,000-ounce long-term production target?
Well, you've essentially identified the defining tension of Contango's entire strategy right there.
Right.
A current ratio of 1.27 means they are technically solvent and can cover their immediate obligations. The $89 million cash balance provides a really comfortable operational runway for the next 12 months.
Sure.
However, exploration and development are notoriously unpredictable, and they burn cash rapidly. Carrying three major development assets simultaneously while servicing roughly $66 million in total debt between the secured facility and the convertibles, it creates a precarious structural profile if cash flow gets interrupted.
So they're effectively betting the house on Moncho executing flawlessly and acting as an internal bank to fund the rest of the pipeline.
Exactly. The entire growth thesis is leveraged to the cash flow from Moncho. If the transition to the South Pit goes according to the engineering plan and spot gold prices remain in this elevated tier, Moncho spins off enough free cash flow to advance Lucky Shot, Kitsall Valley, and Johnson Tract organically.
Meaning they avoid returning to the capital markets for highly dilutive equity raises.
Right, but if Moncho experiences a geotechnical failure or delays in reaching that high-grade ore, that $46.3 million debt facility will suddenly consume their balance sheet.
Which brings us back to the ultimate reality of this earnings print. We started by looking at a pretty confusing set of numbers. A gap beat masked by a derivative accounting quirk, and an adjusted EPS miss driven by the penalty of open-pit mine sequencing.
Yeah.
But underneath all that accounting noise is a company that has aggressively cleared the decks for 2027.
They really have. They have executed a textbook transition. By neutralizing the legacy hedge book on July 1st, they graduated from a constrained junior developer into a fully unhedged producer.
Right.
They traded a toxic derivative liability for manageable 7.4% debt, retained $89 million in cash, and locked in downside protection at $3,400 gold. The financial engineering is brilliant on paper, but everything hinges on operational execution over the next 12 months.
Because if the South Pit grades at Manh Choh underperform the geologic models, or if the FAST-41 permitting timeline at Johnson Tract hits a political snag,
or if that direct shipping ore model at Lucky Shot proves too complex to execute logistically.
right, any of that happens, and that newly acquired debt could become a severe anchor.
It is a classic high-reward mining play. The macro environment is perfectly aligned with $4,000 spot gold, but they have basically removed their safety nets to capture it. The engineering teams have to deliver flawless execution from here on out.
They've set the stage perfectly for 2027. But, looking at the broader landscape of the gold sector right now, it leaves you wondering.
Yeah.
With $89 million in cash, zero hedges capping their upside, and a completely de-risked development pipeline, are they actually trying to build a 200,000-ounce mid-tier producer? Or have they just engineered themselves into the perfect, shiny acquisition target for a major miner next year?
That's the real question.
It is. Well, if you want to keep cutting through the noise of these complex earnings reports and tracking the real story behind the numbers, make sure you follow the Deep Dive show for our daily, no-fluff earnings coverage.